Hello again, welcome to the Alpha Wave Trader Market Update. Today I'm going to focus on gold, basically because nothing really has changed as far as the setup in the US markets and Australian equity markets that we've been chatting about. Just getting more exciting as far as I'm concerned, the higher it goes. But really nothing much has changed, so I don't want to repeat myself yet again on that. So have a little look at gold prices, because they have been interesting of late, picking up steam to the upside. So I thought it'd be interesting to have a look at what all the key levels are around here, just as an exercise to learn a bit about the key bars and these buy and sell pivots, and how to use them to give you a sense of where the possible opportunities are. So if we have a look at gold since 2000, we know this chart well. I'm sure you do as well. Massive rally lasting until around 2012, moving from a couple of $100 up to nearly 1900, and since then it I think really surprised a lot of people by selling off pretty hard for a couple of years, and gold stocks really getting pummeled. A lot of gold stocks falling, upwards of 90% during this period. And I think a lot of the gold bugs shaken out, and the economic theory of people printing money relentlessly, leading to a huge spike in gold prices, didn't really eventuate during this period. And there were a lot of conspiracy theories, of course, wondering why that was. But with the Fed sort of backing off in this last swoon in the US equity markets at the end of last year, the one thing they have inspired is the gold price, as well as equities, on the back of saying they're not probably going to be raising rates much from here, and may leave their balance sheet at quite a large size. So I guess the question is, with the change of tune by the Fed, could it lead to another uptrend in gold from here? Has the consolidation period finished? And the way things are looking, it's not a bad setup where we could actually see a pretty strong move in gold if it can move its price above that sort of 1400 region, just from a very basic technical view, which I'm sure a million other technical analysts are looking at. Is this very strong resistance around this 1400 level. But if we just go a little bit deeper and we have a look at the actual sell-off that we've had, you can see we've got that big wave down. We've got this reaction here, and we've got a bit of a wave structure selling off to the downside. And you can see that prices did bust above the previous lowest high within the downtrend. So that gave us a bit of a hint that prices may be turning around, and that's a very useful tool to look for when trying to decide whether markets are turning around, because once you do have that hint with prices sort of busting above that previous wave, you're then on the lookout for opportunities. So the usual way I like to look at it is that once you've had that hint, you're possibly buying in the buy zone of whatever wave is created to break that level. So if we look at that as the previous lowest high within this little downward structure, we can then be looking at this wave that actually broke that level, and you're a pretty keen buyer around the buy zone of that wave. And you can see prices did end up bouncing right off that 75% level. So I've got the buy and sell zones here of that wave. You can see there, and those levels, 75% retracement to the 87.5%, and that is the 12.5 to 25%. So that's the sort of key areas of that wave, and you can see most of the price action that we've seen since has pretty much been respecting that wave that we've had, this first wave against this little downtrend from the last few years. So things aren't really clear yet, because there is a chance that this could be it, and if prices do fail again, especially back below that low, it could be on for another leg to the downside. So if we just have a quick look at the short-term price action, well, this is over the last few years on the monthly, just looking at the reversals, so those pivot points and the key bars. So I'm just going to quickly analyze what's happened over the last few years. You can see we've got a close above, see that lowest price candle, so that's your monthly buy pivot back in 2016. Then we've got a new key bar to the upside here because it's closed above the high of that buy pivot candle. Then a new key bar 2 months later because it closes above the high of that next key bar. Then another key bar up another 2 months later after closing above the high of that key bar. Then you can see we've got a sell pivot. So we've got a new high here. We've got the close below the low of that highest bar. So there's your monthly sell pivot, a bit of a prior warning. Prices then going back up into the guts of that sell pivot candle and then selling off pretty hard. And we've got a new key bar there. And just keep noticing all the price action that happens after that new key bar is created, and then it goes to try to retest above the top of that key bar but gets rejected and keeps going down. And then look at how it behaves on the way up, looking at exactly the same thing. We've got a new monthly buy pivot giving us prior warning that we may be heading back up. We have a new key bar when it closes above the high of that pivot candle, and look at the price action that happens. Goes back down to retest below and then turns back up. Then we've got a new key bar here. So once you have these key bars, what I'm saying you need to do is to bring up those distributions that I talk about. So if we have a look at price action after this key bar is created, you can actually see that it's related to that key bar, with prices going down to that 618 below, so that level there, which is a key level. You can see prices supported around that level on a few occasions, and also getting rejected, from the sell zone of that bar as well. So all of this price action for a few months before the new key bar to the upside is created is related to that key bar. And so now we're looking at the key bars to the upside again. So where we are right now with that long-winded explanation is to give you that sense that all we need to do is look at this key bar. So that's the most recent key bar in this current uptrend. And that's last month's range. And you can see prices finding support at the exact midpoint of that key bar, which is what you expect in those strong trends. And so we can look at the buy zone of that bar. We can look at the 0.25 below, and the 0.618 below, and we know now where all of the major support zones are and where prices can get to but still be going up. So we need a monthly close below that 0.618 below to get too concerned, and that is down around 1240. So prices can go all the way down to 1240 and close below there on a monthly basis before we get too concerned. So the sort of key support levels that you're looking for with gold from here is down around that buy zone of the key bar, which is around 1290, and then the 0.25 outside that key bar, which is at 1266, and even that 618 below at 1246 could end up providing support, and people would start getting nervous down there. But based on how these key bars behave, and you can see how prices have evolved as it shakes people off, but still ends up heading higher. That's pretty much how you can set things out so that you've got a clear structure to what you're looking at and what you're trading and where the opportunities can be. So that's it for today. Carried on for long enough, but hopefully you're getting a sense of looking at the key bars and the buy and sell pivots to sort of map out where the opportunities might be. Cheers, I'll come back with more next week.